Hey, welcome back to the Consulting Mind. Today, we are going to talk about how the inflation risk is shaping and affecting the central bank monetary policy decision. And I'm also going to give you a very short update on the recent movement of the key central bank. So first, let's start with the Bank of Canada. On the 27th of October, it has announced officially that they are going to end the quantitative easing policy, and they're going to move into the reinvestment phase, and during which they will only purchase the government of Canada bond solely to replace the maturing bond. It means that they are not going to buy extra new bond, and they are not going to provide extra liquidity into the bond market. And the second point is that they also announced they are going to accelerate the potential timing of the future interest rate hike, which makes the tightening process and timeline might be much earlier than the market previously anticipated. And what drives the central bank have to react that quickly towards the monetary policy? You can refer to the right-hand side of the chart. You can see that the trend of the inflation rates in Canada. You can see that the inflation rate has already rise above 4% for consecutive 2 months. So they are seeing a very strong pressure that the inflation risk is going to further worsening, so that they have to react much more quickly than the market has earlier anticipated. And then you can see the market reaction. For example, the 2-year government bond yield has risen sharply from 88 basis point to 110 basis point. And the rising magnitude is quite substantial, as high as close to 30%. And then we can move on to talk about the next one, the Reserve Bank of Australia, the RBA. It has recently declined to buy the April 2024 bond in its regular market operation, and even though the yields were well above its targets of 0.1%. This action is even more drastic than the previous one because basically it is done without any pre-communication with the market. Without any announcement, it directly and sharply cut the bond purchasing buying decision for those bonds related. And the underlying reason is similar, is that you can see the inflation course, the inflation pressure is also very high in Australia, as you can see from the chart. It has already rise above 3% again for 2 consecutive months. So that the Australian bank feel like that they have to react much more quickly than earlier anticipated. And you can see the market reaction is very sharp. You can see the 2-year government bond yield has shot up to close to 67%, almost 3 times higher than 1 week before the action. And then we can talk about the Brazil Central Bank. You can see that here the inflation pressure is in Brazil is also high. You can see a very obvious upwarding trend of the inflation, and there's no sign of slowing or turning the other way around. So that the central bank has decided to raise its benchmark lending rate by as high as 1.5%, which is quite a very substantial magnitude. And you can see the market reaction towards that is that the 2-year government bond yield has up to 12%. And then we can move on to talk about the last one, the Bank of Russia. You can see that the inflation pressure also exists in Russia, and the upward trend is obvious. But then there's a very substantial difference between those, is that you can see that basically the Bank of Russia, their reaction is much more faster than earlier, comparing with other central banks. Recently, it raised again its benchmark rate by 75 basis point to 7.5 basis point in 22nd of October. And early on, it had already increased the rate by 25% in September and 100 basis point in July. Their decision is much more earlier than the other one. And then you can see the market reaction is that the 2-year government bond yield up to 8.3%. And here is one more interesting fact for your information is that In Russia, it is one of the few countries that the benchmark interest rate is still higher than the CPI. This will be very important as it will provide the Bank of Russia more flexibility and space to modify and to adjust their monetary policy to curb the upcoming inflation risk. So finally, what next and what can be learned? The first one is that you can see that obviously inflation is coming fast all over the world. It is not a phenomenon that only occurs in particular country or particular region. Rather, it is more of a global phenomenon, which is triggered by a basket of factors, including the disruption of the global supply chain, the sharp rise in the commodity and the energy price, the cause of the extreme weathers, and so forth. And the second one is that the central bank monetary policy, the quantitative easing policy, the tightening might come much more faster than we can all expect it, or even that we can withstand. And the third one is that the central bank credibility, especially the Fed, might be at risk because not only Fed, but also some of the key major Western central bank has previously insist and talk to the market that the inflation is just temporary, which should not be last for a long period. But now you can see from the actual data and from the actual pattern and trend of the inflation, seems that the inflation is not temporary or transitory. Rather, it is much more looking of a consistent, persistent trend to continue to develop. So, the central bank credibility might be affected because of the previous wrong or the misleading judgment made by those key officials of the central bank. So this is the end of today. If you like the episode, please click the like button for me.